When we talk about cash, there's lots of different things we're talking about, right? I mean, for some people, that literally means the green stuff sitting in a safe in your home so that if the excrement hits the ventilatory system, you can get your hands on a few hundred or a few $1,000s and you can get out, and you can use that to buy gas on the way out or groceries or whatever. But in general, when we're talking about cash, we're talking about something that's a little bit less liquid than that. Now, most of us have some recurring expenses, and we need to make sure we have reasonable cash flow in our lives. So that means having some money in our checking account, right? Someplace where you can use your debit card that your credit card gets paid off with every month, that you can go make withdrawals and make deposits and write checks and that sort of a thing. Okay, so that's going to be some of your cash as well. Now, the downside of a checking account is you're not making any money on it, which is not an insignificant outcome. If you've got thousands or tens of thousands of dollars sitting in there, that's a real opportunity cost, right? That is money that could be earning something, whether it's 3 or 4 or 5%, it could be earning something, but it is sitting there to facilitate your cash flow. And it's all right to have that. Don't beat yourself up about that. All people and all businesses have a certain amount of cash sitting around earning nothing, and that's okay. That is not going to make the difference between you being financially successful or not successful. What I really want to spend time talking about is the next level, right? Whether you want to call it an emergency fund or whether it's, money that you don't need for a few weeks or a few months or a year or two, where do you invest that, right? If you're saving up for a down payment for a house you plan to buy in 6 months or 12 months or 18 months, that's really not money that should go get invested in risky assets. You certainly don't want it in anything illiquid, like some real estate property, but you probably don't want it in the stock market either, even though the stock market is pretty darn liquid, right? You put it in an index fund, you can pretty much have your money back in your checking account 3 days later. But it might drop in value 40% in the meantime. And if the return of your principal matters a lot more than the return on your principal, well, those are times when a cash investment is appropriate. Okay? Now, two of my favorite cash investments are high yield savings accounts and money market funds. And these work very similarly. They're basically a savings account, for lack of a better term. With a high yield savings account, it's generally through a bank, okay? Something like Ally Bank. It's usually a primarily online bank. And these days, they might be offering you 3 or 4% to have your money in there. That's way better than your checking account, right? Your checking account's paying you nothing. And this thing's paying you 3% or 3.5% or something like that. So it's way better. And you can usually transfer money back and forth within 1 to 3 days. No problem. Just transfer it back and forth. As long as you don't need the money today, it's going to be fine to have it in there. Now, the high yield savings account has one benefit over a money market account, a money market fund at someplace like Vanguard or Fidelity or Schwab or something like that. The benefit is FDIC insurance. That's not worth that much, but it's worth something. On up to $250,000 to $500,000, the federal government actually stands behind your deposit. So if the bank fails, you still get your money. Now, it's not like that's a huge risk over with a money market fund. Let's say you're a Vanguard, right? And you're worried, Vanguard's going to fail. Well, there is something called SIPC Insurance. SIPC Insurance essentially makes sure you can get a little bit of cash even if your brokerage fails. But the difference at the brokerage is your money's actually invested in something, right? It's not just sitting in an account of Vanguards, right? It has been used to buy something that has value. And eventually you're going to get the value out of that thing. And so even if the brokerage fails, you still own stuff, via the fund, whether it's a stock mutual fund or it's a bond mutual fund or it's a money market fund, right? Money market funds invest in very short-term bonds. So they essentially can guarantee the buck. You won't lose principal. In fact, it's a very huge deal when they talk about a money market fund breaking the buck. There's a little discussion about this in 2008, but even in 2008, no retail money market fund broke the buck. And even the ones that did were commercial only. And, there was like a 1% loss. It wasn't some huge deal. So the nice thing about money market funds is in normal times, they'll pay more than a high yield savings account. And I would call this a relatively normal time because right now, money market funds will yield more than a high yield savings account. The other cool thing about them is there's different types of money market funds. For example, you can get one that invests only in treasuries. So you're essentially backed by the US government that way, right? It's basically the same as FDIC insurance if you do that, but it is also state tax free. So that's a benefit. If you're in a high tax state, you might like a treasury money market fund, especially if it's paying about the same as a prime or a federal money market fund or some other option like that. And you also get out of the state taxes. So the after tax yield might be even better. The other option you have is a municipal money market fund, right? And these are federal tax free. I suppose if you had a state specific one, and there aren't very many good ones of those, but if you had a state specific one, it would also be state income tax free. And so even though it offers a lower yield, your after tax yield might be higher, especially if you're in one of the higher tax brackets. So that's another advantage of money market funds over a high yield savings account. Now, people talk about other options, right? They talk about very short term bond funds. And yes, your principal is pretty guaranteed there, but it can drop a little bit when interest rates change. People also talk about just buying treasury bills directly from the treasury. And that's a very cash-like investment, but it's not really cash, right? It's going to take a few months or a few weeks or whatever for that treasury bill to mature. So theoretically, if you had to sell it in the meantime, you could lose some tiny amount of principal on that. Plus, there's the hassle, right? You got to go and buy them, and you got to wait for them to mature, or you got to sell them, or whatever. You got to, roll the ladder of them. It's just not quite as convenient as using a money market fund or a high yield savings account. There are other options if you want to guarantee your principal, but you're okay not having liquidity, right? You don't need the money for 6 months or a year or 2 years or whatever. You got a couple of options. One is a certificate of deposit from a bank. And theoretically, that'll pay a little bit more than a high yield savings account. Those are highly variable, of course, so you have to kind of shop around. The other option is just to buy a treasury bond. Right? If you know you need the money in a year and you know you don't need it before then, you can buy a 1-year treasury bond, and that'll pay a little bit more than a money market fund. If it was 2 years to 3 years, you'd get a 2-year or a 3-year treasury bond. So lots of different options for your cash. The general rule is figure out how much you need for your cash flow needs, and a little bit of emergency kind of stuff, and keep that at home or in a checking account. And beyond that, make sure you're getting paid something for your cash, whether you're using a high yield savings account or whether you're using a money market fund. I'm a little bit partial to the ones at Vanguard. They do tend to have a little bit higher yield than the ones at Fidelity and the ones at Schwab, especially when it's just your settlement fund, right? This is the way Schwab makes some of its money and keeps its other fees low, is by it basically doesn't pay you much on your settlement fund, whereas Vanguard's does. So it's one really nice thing about Vanguard. So make sure you keep your cash in a smart place, pay a little bit of attention to it, but don't get all obsessive compulsive about it. You don't want to be bouncing checks because you're trying to keep too much money in the savings account and not enough in your checking account.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.